Strong first quarter corporate earnings are helping to drive stock market gains this month after a down April, but it's taking strong corporate earnings and profit forecasts this time around to impress investors. Research Director Shiraz Mian here now with an update on the action. Shiraz, it's been a while since we've spoken. Let's get right to the scorecard. What is growth looking like?
So growth's looking very good, Terry. Thanks for putting that nice setup for me. So we have 464 companies in the S&P 500 have reported already. That's almost 93% of the index's membership. And this includes this morning's blockbuster Walmart report, which really was impressive to see. So earnings is 4.6% year-over-year growth in Q1. Revenues are up 4% year-over-year. And if you exclude Bristol Myers, Terry, which had a huge one-time charge, and that's obviously the pharma company, so it has a bigger impact in the healthcare. But even for the index as a whole, if you exclude that, then growth improves to north of 7%. So all in all, a pretty good growth pace. It represents an acceleration from what we are seeing in recent quarters, and sets us up for really good earnings the rest of the year.
What about margins?
So that's been one impressive performance on the margins front. You would recall we have been talking over the last couple of years as we dealt with the inflation problems that companies on the whole have done an excellent job in keeping their margins intact. From the tech sector in particular, I have to mention, Terry, the margin performance has been very impressive. And that's been one of the standout, better than expected showing this earnings season.
What about the beat-miss numbers? Have companies largely surprised to the upside?
So that's a little bit underwhelming, if you will, relative to recent quarters. So for these 464 that I mentioned have reported already, 77.6% have beaten EPS estimates. And that's about in line with what we see from these companies in recent quarters. In fact, the average over the preceding 20 quarters, which is 5 years, for this same sample of companies is exactly that number. So it's the EPS beats is average, but the revenue beats is very underwhelming. For these 464, 59.9% are beating revenue estimates. The average for this group over the preceding 20-quarter period is 70%. So significantly below average beats percentage on the revenue side.
So then companies are struggling to impress investors this quarter? Is that accurate?
You could say that. Or another way to put it would be, Terry, that if you step back from the results and try to understand what the broader narrative surrounding earnings investors of the market as a whole has latched on to, it is that earnings are okay. They're not great, but they're not bad either. And then there are signs in some sectors, in some industries, with some companies, where the picture is extremely good. So if you see any evidence, if the market sees any evidence from a company that it isn't really living up to that narrative or that view, then that stock gets pummeled. But on the whole, when results come in as expected or modestly better than that, then the market essentially shrugs it unless the company is able to talk up the outlook for the coming quarters as well.
And on the corporate guidance front, are companies more or less pessimistic?
I think they are less pessimistic. So there are pockets depending on what type of end demand the companies are faced with. There are companies that are very upbeat about the outlook. I mentioned Walmart at the top of our segment. Walmart, as you know, has touch points across the economy with every type of consumer, and they largely had upbeat things to say about the health of their business. Now, there are others that have not been that optimistic and positive. So, but net, uh, the the very negative narratives that were really there in the market discourse a few quarters back, those narratives aren't getting confirmed by these management teams. So, on the whole, the commentary is either positive or neutral, though there are some companies that are struggling.
So, firms that missed expectations seem to be getting punished really hard in the market. Is that what you're seeing?
That's right. Yeah. So, these companies uh, are out of line with the macro narrative, if you will, as I put it earlier, in the market, that the earnings picture is okay, that the economy is okay, that consumers are chugging along, though there are some issues in some pockets, but on the whole, the demand picture looks good. Now, when management teams come out and say something that's not in sync with this view and narrative, then they do get punished real bad, and we have seen that with a number of companies.
You mentioned Walmart reported this morning. You mentioned the tech stocks. What are some of the stocks that really mattered this earnings season?
So the so-called Magnificent Seven, which is basically these trillion-dollar companies, the Microsofts, the Apples, the Nvidias of the world. Nvidia, by the way, hasn't reported results as yet, but these companies, as you know, Terry, have been in the forefront of driving the market gains since last year. Uh, and these companies are also leading the charge on the artificial intelligence front. They're spending a lot of money in terms of capital expenditures on data centers and deploying the infrastructure for artificial intelligence. So, one key question in the collective mind of the market was whether results would justify the momentum that we had been seeing in these stocks. And by and large, the results confirmed that, meaning, yes, they are coming out with business models that will monetize the AI developments, that artificial intelligence doesn't appear to be just irrational exuberance, in the words of Alan Greenspan, as he put it back in the 90s. So that was a big key part. Consumer, we are talking about now in the context of Walmart. I think Walmart was very important in that context because, as we said, it has so many touch points. There were other consumer-centric companies, the airlines, the leisure, hospitality. They came out with good results as well. Now, companies that are more exposed to lower income, they seem to be struggling. So that I would say are like some of the key companies and areas that we saw this earnings season.
And we're talking here on Thursday, May the 16th. This week, the retailers either report or have reported already. Do you expect to see a lot of inflationary pressure or signs of consumer pullback in those reports?
So that was my big worry in the Walmart report as well, Terry. Walmart, full disclosure, is a stock I own in the focus list portfolio. Has been a standout performer for us. The narrative with Walmart for some time now has been that it's gaining market share in the grocery business. Walmart is more than 60% groceries. And its merchandise business has been struggling as it has been for many other companies. And it's been gaining share in the higher income segment of the market. But we all know that Walmart has a substantial lower income leverage as well. And my worry coming into this report was as to what effect, if any, the well-known stresses in the lower income side of the distribution will show in the Walmart results. It did not appear that was a problem here, but we saw that with McDonald's. I suspect this lower income pressure and stresses we will see with the other discounters, the dollar companies that are set to report in the coming days. So yes, there is a clear sign that the lower distribution on the income side is struggling. Inflation is a big contributing factor to that.
Also, it would seem to me anyway, that the fact that Walmart is attracting the higher income customer is an economic statement. It's an implied economic statement. Is that, you see it that way?
There's some of that, Terry. You meaning higher income folks trading down to Walmart. So I'm sure there is some of that going on. But on top of that, you would recall that Walmart has been, it's no longer just a big box brick and mortar operator. Last couple of years, the business has really evolved, and it has this growing digital business, and it's in that business that it appears to be gaining share. So there's a big convenience element in the Walmart business too. There's home deliveries. You order and pick up at store. You order and pick up in the parking lot at the store. And that convenience factor appears to be also at play in attracting the higher income consumer. But definitely, the hunch you described absolutely has something with that too.
So it may not just be higher income folks looking to get cheaper grocery prices.
Some of it is that. It is higher income consumer trading down to get cheaper groceries from Walmart. And there's also that higher income consumers now find shopping at Walmart a lot enjoyable and convenient compared to the Walmart that we know of 5-10 years ago.
Okay, so what are you looking for Q1 2024 as far as the earnings growth is concerned?
So when we combine the few companies that are still to come with what has come out already, the expectation is a little north of 6% earnings growth and a little north of 4% revenue growth. Excluding energy, the growth improves to about 9%. So all in all, a pretty decent growth acceleration from what we saw in the last few quarters of 2023.
Okay, and don't forget, want to remind everybody that they should be checking out your written commentary on Zacks.com that gets updated every Monday and Thursday. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.